The early days of a small business are tough. You have all these grand plans, and it might get to the end of the first year and you look and you've actually made a loss. Well, can this loss actually help you save tax elsewhere? Let me explain. The first thing that we have to look at is, what is your structure? Are you a company? Are you a trust? Are you a partnership? Or are you a sole trader? And this is a really key thing because these each have different rules on how they work when it comes to deducting these losses. And it's why setting up your structure is so important, because you need to get this right from day one. So definitely go and seek the right advice in this area before you start your business. So let's quickly touch on a company. So if a company makes a loss, that loss will be deferred to a future year. You can't offset against any other income because the company is its own entity. So the loss will simply roll forward. And if you make, say, $1,000 loss, in essence, you're starting the next year from negative 1,000. So when you make a profit in the future, you can deduct any losses that have happened in the prior years. There are a couple rules around similar business types and continuing ownership, but they're a little bit too complex for today's topic. So the next entity type to look at is a trust. And a trust is similar to a company when it comes to losses, because the losses can't be distributed to beneficiaries. Instead, they roll forward to future years, and again, can be used against any future year's profits. So that is the key thing to understand though with a trust, is you can't distribute these out to the beneficiaries. Now, a partnership and sole trader are going to work in similar ways, because a partnership in essence will split things out at an individual level, and then they're treated the same as a sole trader. And these are the ones where you potentially can offset these losses against other sources of income, but you need to make sure you meet the non-commercial loss tests. So let's talk about those rules. Let's talk about those tests. It's what a lot of people get confused about. And these are in place pretty much to stop someone saying, oh yeah, I'm running a business, claiming bits and pieces with no real intention of this ever being a real proper business, and then deducting these losses against their personal income and saving all this tax. You're going to have to meet these non-commercial loss rules to be able to achieve that result. So there's really two main areas to this. There's some basic rules, and then there's some tests, which are known as the 4 tests. So let's look at the basic rules first. So the first one they're looking at is, are you in business? So to claim a loss, you need to be actually in business. So in essence, this one is really just looking at, are you actually doing the steps to run a business? A bit like the hobby versus business test. They want to make sure you're actually running a legitimate business. The next one is similar business activities. So if you're carrying on more than one business activity and they are similar, you may group them together when you're considering the non-commercial loss rules. If they're different types of businesses, then you need to assess each one on each individual non-commercial loss rules. Now, the third one is that there are a couple accepted activities. So these are primary production or in professional arts, and these have slightly different rules. So if you're in either of those two industries, make sure you go do your own research to find out if you can still apply the non-commercial loss rules in maybe a slightly different way. And then the fourth one is you need to have less than $250,000 of income. So this is the total of your taxable income, reportable fringe benefits, reportable super contributions, and total net investment losses. So this has to be under $250,000 for you to offset the loss against other sources of income. If not, you must defer the loss, or you can apply for a commissioner's discretion. So most of those are pretty basic. A lot of people that are running small businesses are going to be under $250,000 of other income. If they're running a small business, they pass that are you in business test. And then a lot of the time they are just running one business. So they pass all of them. Then it comes down to the 4 tests. So you need to pass one of these 4 tests to be able to offset your losses against other sources of income. So we need to look at what are these tests and do you actually pass any of them. Now, while there are 4 tests, the first one is the main one that 95% of businesses are going to pass based on my experience of seeing this happen. And this is the assessable income test. So if we have a look at what the ATO say here, they simply say that to pass the assessable income test, your assessable income from your business activity during the financial year must be at least $20,000. So what is assessable income? Well, assessable income is the ordinary income. For example, the gross earnings of a business, and statutory income, for example, capital gains. So you need to be turning over at least $20,000. And this is what stops a lot of people starting businesses that aren't really businesses and deducting those losses, because they don't meet the assessable income test. Now, there are some unique situations, and you can read more about this on the ATO website. Maybe you've done a part year of business, so you can bring that across a full year and see how that would have looked. But in general, if you turn over $20,000, you're going to tick this box, and therefore if you do make a loss, you can deduct this against your other income. The next test is the profits test, and I have seen this one be used a few times. So the profits test states that your business will pass the test if it has made a tax profit in 3 of the past 5 years, including the current year. So maybe you're not meeting the $20,000 of turnover, but you're making a small profit each year, and then one year it comes along and you make a loss. Well, you can still deduct this loss as long as you meet this profits test. So it is a handy one to keep in the back of the mind if you're running a small business. It's never going to grow too huge, typically is profitable, but maybe you have a bad year once off. Now, the other two tests are in regards to assets. So we have the real property test. So you pass the real property test if you have real property of at least $500,000 that is being used within your business activity on a continuing basis. So this is like land and buildings. I've never actually seen this one apply on a small business scale because by the time you start to get large property like this, the chances are that your business is probably turning over $20,000. There's probably a few unique situations where this one applies. The other asset-based test is literally known as the other assets test, which is passed if you have at least $100,000 of assets that are being used within the business, but only certain assets are included. So this includes items of plant and equipment, trading stock, assets that are leased from another entity, or trademarks, patents, copyrights, and similar rights. So again, it's only going to apply in really particular situations where maybe you've had to invest heavily in a business in a startup phase, but it hasn't started to turn around income. This is where this potentially could apply. Now, before I talk about what happens if you do or don't meet the non-commercial loss rules, I really would love for you to hit that subscribe button. We're trying to get to 10,000 subscribers by the end of the year. So we need about 10 or 11 subscribers per day. So I'd love for you to hit that subscribe button if you haven't. And if you already have, thank you so much. I really appreciate your support. Let's get back into the video. So what happens if you pass the test? Well, if you pass the test, you can deduct this against your normal income. So say you earn $80,000 from employment income and you've got a small business on the side and it's turning over $30,000. So you meet the assessable income test, but you've had about $40,000 of expenses. So you've got a $10,000 loss for this business. Well, this $10,000 loss can now be a deduction. So your taxable income goes from $80,000 down to $70,000. So in essence, the tax savings in this situation is going to be approximately 34.5%, being the 32.5% tax rate and the 2% Medicare levy. So we now end up with a real tax benefit here of $3,450. Now, because your employment income has likely been withholding correctly throughout the year, you're likely going to actually see this $3,450 as a tax refund. So this is great because it's going to help offset some of those losses. Now, obviously, the ultimate aim of the business is to eventually turn a profit. We don't want to keep making a $10,000 loss every year. But at least in this situation, we're recouping some of this maybe during this startup phase where cash flow is probably going to be tight. Now, what happens if you don't pass the test? Well, the losses don't completely go to waste, but they get deferred. So these losses get deferred to a future year, and they keep getting deferred until you meet these tests. So you might have $5,000 of losses in one year, $3,000 the next year. So we've now got $8,000, and now we meet those tests, and we can deduct these losses against that. So it is something to keep in mind, and it's something you probably should talk to your accountant or tax agent about so that you're aware of where are my losses at, so that if you do start turning a profit, you're going to use them then, or maybe you do start meeting the tests and you're going to deduct them then. It's why structuring when you've got small businesses is really important. And what else is really important when you've got a small business is watching my upcoming playlist all about small business tax tips, where I go through a range of different topics, helping you to better understand your small business taxes. I can't wait to see you over there.